Welcome to The Explainer. Today, we're diving into a genuinely fascinating breakdown of passive income. If you've ever felt like financial freedom is locked behind some impossible multi-million-dollar paywall, well, you definitely aren't alone. But today, we're going to unpack a data-backed blueprint that reveals how real people are actually living off dividends right now. And spoiler alert, they aren't sitting on multiple millions of dollars to do it. $300,000. Honestly, just hearing that number completely shatters the biggest myth in personal finance. This deeply ingrained idea that you absolutely, positively need $1 million or more just to retire. It's simply not true anymore. According to the data we're exploring today, there are clients who are comfortably stepping away from the daily grind and living strictly off passive income with a nest egg of just 300 grand.
Now, you're probably asking yourself, come on, is it really possible to live off 300K forever? Well, the data points to a resounding yes. We aren't dealing in hypotheticals today. This entire breakdown is based on actual working client portfolio strategies. Real quick, friendly disclaimer though, this explainer is strictly for educational purposes, not personalized financial advice. You've always got to do your own research. Okay, here's our roadmap for today. We'll start with the passive income myth, explore the 4 dividend asset categories, look at actual portfolios by size, and then finish up with crucial rules before investing. Let's kick things off with Section 1, the passive income myth, and defining your true target number. Without a clear target, we're basically just throwing darts in the dark, right? So let's do the math. The median household income in the United States sits around $83,000. Now, as a general rule of thumb, you need about 80% of your working income to live comfortably in retirement. So 80% of that $83,000 gives us $66,400. Next, we factor in average Social Security or maybe a pension, which is roughly $24,000 a year, and we subtract that out. Boom! Our magic number drops to a dividend target of roughly $42,000 per year. Suddenly, the idea of ditching the 9-to-5 feels a heck of a lot more achievable. Moving right along to Section 2, 4 dividend asset categories. We're going from the safest concrete to the riskiest glass. Think of this next part like a blueprint for building a house, where we ascend the risk ladder. We start down at the bottom with our solid concrete foundation, cash and equivalents. We're talking high-yield savings accounts or treasury bills currently yielding around 3 to 4%. Next up is the sturdy wood frame, blue chip, dividend stocks and ETFs. Think massive legacy companies like Coca-Cola. Then we get into the slightly trickier stuff, covered call ETFs. And finally, perched at the very top is the fragile glass, highly speculative and crypto-backed yields. But wait, before we go chasing those massive yields, we absolutely have to talk about everyone's favorite topic, taxes. If a dividend is classified as qualified, like the ones you'd get from a rock-solid ETF such as SCHD, it's taxed at the low long-term capital gains rates. That's usually somewhere between 0 and 15%. But if it's an ordinary dividend, it's taxed at your standard income level. And for a high earner, ordinary dividends can get taxed at 30% or even higher. Picking the right asset class is literally the best way to legally keep the taxman away from your passive income. So let's zoom in on that third category for a second. Covered call ETFs are basically a superpower for passive income. It's actually a fascinating mechanism. The fund holds a huge portfolio of stocks, say the S&P 500, and it generates high monthly income by selling call options on those exact holdings. They collected premiums from those options and pass them straight on to you. It's an incredible tool for high yield for sure, but you definitely have to keep a close eye on how those specific distributions are taxed. And that brings us to a super crucial piece of financial jargon you absolutely need to have in your vocabulary, return of capital, or ROC. You see, some covered call ETFs pay you using ROC. Here's how it works in plain English. Let's say you buy shares of an ETF at $80 each. The fund then gives you $4 back per share as a return of capital. You don't pay income tax on that $4 right now. Instead, your taxable cost basis drops from $80 down to $76. Basically, you're getting tax-deferred cash flow today in exchange for a potentially larger capital gains bill tomorrow when you finally sell. When we compare these concepts side by side, you can really see the stark contrast in yields and risks. Over on the low-risk side, SCHD yields a very safe, qualified 3.8%. Sitting in the middle, QQI hits 14.32% using those option strategies we just talked about. And out on the high-risk edge, BTCI sits at a massive 27.8%. But listen to me carefully here. Watch out for the bear trap. Assets offering 30% or more might pay you a mouth-watering dividend, but they often do it by secretly eroding your actual initial capital. Speaking of high risk, let's touch briefly on that fourth category, speculative yields. The source material highlights an asset called STRC and describes it perfectly as a hybrid between a high-yield bond and an equity, engineered around Bitcoin. Now, what's purely astonishing about this is that STRC was still paying an 11.5% yield even after Bitcoin dropped 50% in value. It's totally wild. But make absolutely no mistake, you must treat assets in this category strictly as risk assets, not guaranteed sleep-at-night cash. Okay, let's get to the fun part. Section 3, Portfolio Blueprints by Size. Let's finally put these puzzle pieces together. Let's start with the big one, the $300,000 portfolio. To generate over 42 grand a year with a nest egg of just 300K, you've got to run a very aggressive, high-octane build. We're talking 60% in QQQI, 20% in that highly speculative BTII, and 20% in SPII. Now, this setup generates an incredible $49,800 a year, but, and this is a huge but, it requires taking on borderline uncomfortable risk. Sustaining this level of day-to-day volatility forever is incredibly stressful, and you've really got to have the stomach for it. So let's see how things change when we move up to the $500,000 portfolio. Notice how much breathing room we instantly gain here. You can build a much, much safer foundation. We allocate a solid 30% to low-risk SCHD, 20% to SPY, and 20% to IUI, which, by the way, is backed by gold, a traditionally stable asset. We round it all out with 15% in QQI and a split 15% between the S&P 500 Growth Fund VOO and just a tiny splash of STRC. This beautifully balanced portfolio clears that $42,000 hurdle with significantly less anxiety. But what if you scale things up to a cool $1 million? Well, with $1 million, you don't just hit the 42K baseline, you completely blow right past it. This blueprint creates a remarkably robust $100,000 a year income stream. We're looking at 30% SPYI, 20% QQI, 30% perfectly split between foundational SCHD and VOO, plus 10% in BTCI and 10% in IUI. This portfolio perfectly balances high yield for your life today with foundational growth to protect your life tomorrow. Which brings us to Section 4, Crucial Rules Before Investing. Whatever you do, don't trip at the finish line. Okay, before you run out and restructure your entire financial life based on these blueprints, we really need to talk about the single biggest mistake people make. Do not use these strategies during your growth phase. Building wealth and harvesting wealth require two completely different toolkits. Chasing high-yield dividends while you're still trying to aggressively grow your account to $500K or $1 million is going to result in massive tax drag. It acts like an absolute anchor on your momentum. You absolutely must separate your growth strategy from your income strategy. Which leaves us with one final incredibly important question. Are you still aggressively building your nest egg, or are you finally ready to design your harvest? Take a hard, honest look at your current financial stage. If you're still building, stay the course and keep focusing on growth. But if you're truly ready to harvest, well, you might have the exact blueprints to start living off passive income. Thanks so much for joining me on this explainer, and we'll see you next time.